Good day, folks. As a Canadian, I feel like I've woken up to a brand new world. Canada has some major catalysts coming in the next couple weeks that could hurtle us into a recession that we need to talk about. I have been buying stocks aggressively. My wife and I fixated in the United States, and I want to explain to you why. Is traditional legacy dividend kings have lost their oomph. They're kind of dying, not in the sense of going bankrupt, but they've been horrible places to park capital. And I see too many investors praising these stocks. And I think we're getting a sense of the new world we're in based off this inaugural event. We're not seeing your traditional Exxon CEOs, your General Electrics, your Walmart CEOs. We're seeing the president surround himself with the companies that are propelling the market and propelling the new age of media. When you're talking about Mark Sundar, Jeff Bezos is here. You got Mark Zuckerberg. We need to kind of, Jeff's wife, we need to put a little black thing there. We got to cover that up and blur it. But still, you have to recognize that these are the guys that are propelling the S&P 500. The S&P's up almost 4% year to date, is now back to tapping all-time highs. And it really goes to show why you can't be too fearful in these volatile moments. You kind of got to keep cost averaging through it, but you have to be cognizant of where you're cost averaging and where your money is going to offer the highest rates of return. And if we take a look at the catalyst coming up in Canada, why as a Canadian investor, I've been just taking this a bit slower. I've been holding off a little bit just to see what happens over the next couple weeks. Firstly, tariffs could absolutely decimate our economy. We have two tailwinds that are really concerning right now. Trump, who promised tariffs on day one, is now saying till February 1st, and I think it's for more or less negotiation tactics. I don't know if this is an actual thing, even though our politicians are fear-mongering the heck out of everybody. We'll see what comes into play, but this immediately would hurtle us into a recession. And we also have the Bank of Canada doing its meeting on January 29th, which will dictate what happens to the Canadian dollar, because if they cut rates again, the U.S. is still going to remain very dominant with higher rates, where you can get better fixed rate returns, or basically where people want to have less volatile exposure to equities, they'll put it in fixed assets, right? And it also is on the back of the Canadian dollar that's been devastated. So anybody that's been buying U.S. fixed assets have been seeing almost a 15% increase since 2022 or the end of 2021. And even over the last year, it's been decimated, right? Our dollar continues to get absolutely destroyed. So if you're in the US buying anything from Canada right now, you are getting a 15% discount just from a couple years ago on the dollar conversion. But now if Trump tariffs us by 25%, that is really going to hurt a lot of, US people. They're already going to kind of get the discount on the dollar, but it's going to be a mess because tariffs don't do well for either side of the border, and it would definitely ruin our economy pretty quick. So we'll see what actually comes into fruition, but this is why I continue to focus. My wife and I focus on the United States, and I want to talk about it more in depthly. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey by hitting that subscribe. If you like my portfolio tracker, you want to see how the wife and I manage our stocks, or you want to talk with me directly, go to kylelivingston.com, a link in the description below. Support the channel through some of our products. Now, I want to talk about the stocks that I'm buying in a moment, but I want to talk about the traditional legacy stocks and how they're not in such a good place, because I go on a lot of stock apps and I see a lot of people in forums and they really praise these companies, and they really shouldn't be, even if they're dividend income oriented investors, because these stocks are not offering the total returns they once did, and there are much better places to park your capital today. But we've seen some pretty resilient earnings across the board. I was very pleased with the earnings we got, but they're not enough to really justify, making these individual stocks scalable positions anymore in your portfolio. Procter & Gamble, right? This was the traditional couldn't go anywhere, your toothpaste, toilet paper company. And over the last year, it's only up 12%, and it's starting to recover on its earnings. Over the last 5 years, the returns have been absolutely abysmal. And it's no surprise when they're only growing at low single digit sales. These are not good sales, but you might see a headline of, oh, their earnings were up 30%, but they had basically, one-off impairment charge that was from this time last year that they're not having anymore. So it increased their bottom line. But from the top line aspect of things, it's not resilient at all, right? You look at the companies like 3M. These are huge recovery plays that offered very little returns over the last 5 years. But if you're able to buy the dips, you did exceptionally well, right? And 3M, again, we're not talking about incredible returns, but they are increasing their margins, which I guess is getting people excited here, which is helping, with their bottom line, but net sales are still low single digits. You look at the airlines, right? This was a graveyard for capital, but they're starting to recover as people are traveling more and there's more demand for airline use, which is great. But you couldn't park capital here. Did anybody actually buy this in 2021 and ride the last 5 years of abysmal returns? Somehow I doubt it. But you take a look at total operating revenue increasing 6.2%. Again, nothing absolutely astounding, 7.8% on the quarter, but 6.2 on the entire year. Obviously, operating expenses, a little bit of an increase there, but 21% on operating income. Again, the EPS looks incredible, but the top line just, there's nothing astounding about it, in my opinion. Look at Johnson & Johnson. I see people ranting, raving about this company a lot, and you look at the 5-year return, and I think there's some hope in the future for this company because they've done some acquisitions, share buybacks, they're doing everything they can to try and bolster future returns, but it has been a place for capital to come and just die for the most part. I mean, again, reported sales are mid-single digits. I mean, nothing exciting, right? Diluted EPS, though, up 17%, double digits. So they are able to increase the bottom line again through share buybacks, probably some operational efficiencies, increasing margins, whatever they can do. But they just don't have the liquidity. They don't have the margin, playable like big tech companies do. And we see it in companies like Netflix. Netflix has become such a sticky business that they've been able to increase prices, lock down on password sharing, things that really annoyed people, but didn't stop people from signing up. Hasn't slowed them down. They had a lot of catalysts over the last couple months when it was the Mike Tyson fight. They've had a lot going on with Squid Games, a few big bangers that really, bolstered their streaming memberships. Because, I mean, from 282 million to 301 million, I mean, just quarter over quarter here, or is this Q3 20? Yeah, literally quarter over quarter. What a huge jump, like 15%. So they're in an incredible place, right? They're seeing margins start to expand here. Overall, the revenue growth is, double digits still. 16% with forecasted 11% for Q1. Operating margins, again, done very well here, usually in the 20 percentile or higher. These are your tech companies, which is why I really want to talk about. I continue, and I kind of breaking my rule here by buying more Google stock. My wife and I own Google. It makes up well over 5% of our portfolio today. She owns Meta. The two biggest single stock positions are Meta and Google. And I'm very comfortable with this. And I think, the sign is on the wall where the growth is. And it's kind of incredible when you compare these traditional old school companies to something like Google's revenue, right? I mean, it's absolutely jaw-dropping, really, at the growth rate and the sustainability of this. And again, you look at the media, you look at the business this has, and look at the sustainability, the growth, and the fact that this thing's growing in double digits at the scale that it's growing. And again, look at the size of Netflix is worth what, $400 billion, and Johnson & Johnson's only worth 344. I mean, you look at how quickly all of the entire world is changing from, basic traditional companies that had the growth vectors behind them to technology. And this is why you can't bet against tech, because, you look at this chart and this chart doesn't lie. How are these companies so big and still able to grow in double-digit territory? I mean, this is astounding, right? So this is why I had no problem picking up a few more Google shares. I bought more S&P 500. Yes, I converted a bit more of the dollar because I'm very worried that if interest rates get cut, if Trump tariffs, we're going to see a further collapse in the Canadian dollar. So that's putting me on edge a little bit, which has made me want to buy a little bit more US. In total, I think the wife and I have about 20% exposure to Canada. The rest of it is just mostly the United States. And I think I'm going to sleep a lot easier at night knowing that is the exposure I have. But again, I want to buy more Canadian stocks, and I will be buying a lot more Canadian stocks. I'm just sitting here patiently wanting to see what the volatility is going to look like. In total, though, we've now seen double-digit returns. My portfolio hasn't updated the returns for the making of this video because the portfolio tracker only updates once a day, but we're sitting at about a 3% return, which is great compared to the S&P that's up 4%. We'll see how that plays in, because I know SCHD was trucking along since the beginning of the year, absolutely crushing it, but now SCHD has started to pull back today on the back of tech kind of rallying up a bit. But still, between all of our stocks, we're in a very great position, I think, for 2025, and I look forward to seeing how this year pans out. But I think as an investor, you have to be very cognizant and not get caught into your own bias about companies that you like based off past performance, because that does not represent future return. And again, I am a total return investor that would like to see my dividend yield get closer to 3%, but with the growth vectors in our portfolio where our money's allocated, I think is more appropriate. So between the wife and I look forward to updating, because I'm going to do monthly updates on our combined accounts and what I think. So again, you can go sign up to my courses to see that, but otherwise I will pass the question off to you. Where do you think we're headed? And how do you think the economy is going to perform on the back of, Trump policies, the Canadian economic circumstance? I'd love to hear about all of it in that comment section below.